Clint Edgington is presenting Nest Opportunity Fund. It's a qualified opportunity zone fund, a multi-asset fund, uh, doing opportunistic strategy with low risk or lower risk residential
Comparatively.
investments in Ohio and Kentucky. We were talking a lot about risk earlier today. There's no such thing as a risk-free investment, and opportunity zones aren't really low risk, but in terms of the opportunity zone universe, this might be on the lower risk end of that spectrum. Clint, enough
Yeah,
from
we
me.
like to
Let's
think
hear
it
from
is.
you. You've got 15 minutes. Please dive in when you're ready.
Thanks, Jimmy. Yeah, we like to think we put together an offering that is, relative to in the OZ world, a relatively low risk. And it is going to have slightly lower returns, most likely than some of the other things that will be in favor in the next 10 years. But we're conservatively run. And Jimmy, I'm excited to tell you that this summer when you and I were on this, I did a kind of walkthrough of one of the bombed out, properties we purchased. Um, and it was a little aggressive. There's a basement, scene that was a little Blair Witchish, but we actually put together a video of kind of side by side of going through that tour and then also kind of where we're at now in the process. So um, that that property is it's got some issues with permitting and whatnot since it's a burn property, so it takes some time. But I think we're going to be pretty happy with where we're at with it. So I'm going to go ahead and share my screen.
That was a big game changer last time around, Clint. That live walkthrough of a property. That was the first time we've ever seen one of those on OZ Pitch Day. You broke new ground with that one. I can see your screen, so
It felt a little aggressive when I was trying to
it
set
was
it up, make
fun.
sure I
It
didn't
was a
want
lot
it.
of fun.
Yeah, so Clanchton with Nest Opportunity Fund. We are a multi-asset fund working in kind of smaller properties, residential real estate in the urban core. We do heavy rehab of kind of the worst property on a street that's trying to turn. Um, so it's what we built for ourselves originally before we even knew that we were going to open up to outside investors. And it's what my family and I have done for quite a while. Um, and so it just seemed to make sense. We had an operator that was working in an area that we now know to be an opportunity zone. So we kind of just continued doing what we were doing. So walking you through, I'll let you read our forward-looking statements, but in the OZ world, as in any other investments, there are risks. And although our fund is relatively, I guess, comparatively on the conservative side of OZ funds, there's still certainly risks. But while you're reading that, I just want to mention that we have a webinar that we're going to do next 2 Thursdays from now, March 21st, 11 a.m. And that's really going to give more information than what I'm able to today. So if you're interested, let's talk about it. We're located in Columbus, Ohio, and Ohio is very supportive of the Opportunity Zone legislation. In fact, there's a 10% tax credit that we're working with Andrew on kind of we're testing demand, see if folks are interested right now, but we have entities that are solely investing in Ohio. So it would be easy for us. Most of our investments are either in Columbus, Ohio, or Lexington, Kentucky. And just sometimes I like to just start with the social side of the Opportunity Zone Act. And that's really to kind of broaden some of the gains out amongst folks who maybe haven't had it. And this is Clint Capel, who runs the Columbus group. And he kind of has a passion for helping folks on the road to recovery from addiction. And that's the people that he hires to do some of his kind of demo work and whatnot. And they become kind of skilled, and it's actually been pretty successful and something that we can get behind.
We are currently daily impacting our community. We are providing safe, secure housing for people to have the opportunity to live their best life. We are providing the opportunity for those in transition to utilize their current skill set or develop a new skill set so they can live their best life.
And that's really Clint's passion. He brings folks in that might have a hard time getting that first job once they've graduated from some sort of recovery program, and then starts to give them skills. And there's a little bit more turnover in the beginning. Some people, will relapse, but we've never had issues with theft. And those that stay become more skilled, which are the more difficult people to employ and retain. And they're incredibly loyal to them. So, just thinking about why, we're on the more conservative side. both in our asset class, kind of where we're at in the Midwest. We have a good chunk of our assets are in single family. And single family doesn't make a lot of income, but it does have relatively lower volatility. In particular, it doesn't have the volatility and the exposure to interest rates to the extent that multifamily does. So we also have some multifamily. So over the last year or two, it'd be a tough place to be solely in multifamily. Cap rates are starting to move up a bit, as you would think they would when interest rates go up. And so, we know in 10 years, folks are going to want to live in single family houses, but we also have multifamily as well. And single family, residential in general is going to be on the more conservative side of real estate, but we all have a pretty aggressive activity in that we're doing heavy rehab or new development. And so we're in the heavy rehab area. Our locations, Columbus, Ohio, and Lexington, Kentucky, kind of flyover country. But within the Midwest, those are two of the areas that are sort of magnets. They've got large universities, and they're in the kind of the growth areas. Columbus is I think it's the top Midwest MSA for growth. It's over 1 million people, and we've got really stable employment. So it's like a lot of things in the Midwest. It's kind of boring but stable, but we are not in the Rust Belt. So it's a good place to do business. In particular, in Lexington, there's supply constraints because there's the desire to keep that kind of rural view and that rural lifestyle. So there's a lot of the horse farmers around there that have had their land, they sold the development rights off. Everything you see that's green there, the development rights have been sold off. And then everything outside of the outer belt is in the urban growth boundary, and they don't provide city services outside of it. And there's also lot split restrictions. So you can only split your lot once in your lifetime in half. So they're not going to vote on that again until 2028. So for a while, there's a lot of, I think, good kind of supply constraints to help our pricing with rents. Columbus is a little bit more of a growth story. There's no real supply constraint other than kind of urban sprawl is starting to happen, and we don't like driving an hour to work here in the Midwest. But it's the largest city for population growth of large Midwest cities. It has the highest population growth, private sector job growth, and we have good kind of educated youth to stay. In particular, you might have heard that Intel is creating a pretty large silicon production facility here, and it's a real thing. I went by it a month or so ago, and you just see a lot of giant cranes there, and everyone who I know who's in the trades and larger firms, they're all being kept pretty busy with it, and it's ricocheting down some to folks that do work on our properties as well. But we are starting to see labor prices come down a little bit in both spaces, and our calls are getting returned by plumbers and HVAC techs. So we think we're in kind of a good place. In Lexington, we're located kind of in the Novi area and some of the Georgetown areas. So we've got 43 single family properties, 4 multifamilies, a couple of duplexes, and then we have some lots in Lexington as well. In particular, when we kind of zoom in where we're at, we think we're in the path of improving area. Rupp Arena is going to expand its convention area by I think 10, and it's currently in construction now. But you'll see there's kind of an old bus line, the gray line that was just a dilapidated old building. And then there's the Artist Village. And there's really kind of our line of properties goes right in between those. And they're really doing a lot of work on that. And they're connecting everything with the bike paths. It's gonna be pretty cool. Columbus, the properties are bigger, more expensive. However, we have fewer. So we've got just a single family here, a couple multifamily, and then 8 duplexes. And here is where I'll walk through one of the duplexes.
Clint is doing something that has never been attempted in the history of OZ Pitch Day. This is our 9th Opportunity Zone Pitch Day. Clint is doing something crazy. He's going to actually do a live site tour of 2 different Opportunity Zone properties. So we've broken up his presentation into part 1 and part 2. So in part 1, he's going to do the before walkthrough, what a dilapidated property looks like. So tell us about it. Tell us what you're doing. take a few minutes to give us the little rundown here, Clint.
This is a property in Franklinton, a neighborhood of Columbus, close to the central business district. It is part of kind of the urban revitalization that's occurring here. In the distance, you can see some high rises there. And so we're within walking, really a bicycle ride of the downtown. But this Franklinton area is kind of undergoing a lot of change. There's a lot of properties that have already been rehabbed like this, which would be nice to take you through. But we're going to get a little bit dirty. I'm going to don my favorite rehab piece of equipment, the headlamp, and we're going to go in. Oscar, can I sneak by? Thanks. This is Oscar. He's working on some of the demo work here. To really kick off the party, I'm going to take you where I always look first in a property. All of our properties are going to look like this. Generally, when we buy them, we are usually buying the worst property on a block. Almost never. This property was a burn property. So we're going to have additional structural and permitting that needs to go into place. And because they're all going to start off as condemned. This is a 2,500 square foot-ish unit. And excuse me, fellas. And then hips, gabling and stuff can get very expensive. So you can see this property. Here's where the burn was. This upper third floor is always an issue for us because we have issues with, we need to create this firewall if we're going to keep it as one issue, or firewall the floors if we're going to have one full unit. And so this is the beauty of 869 and 871 Bellows.
This was a first on OZ Pitch Day. Again, this is Clint with Nest Opportunity Fund. And
So where we were at was the Franklinton area. And you can see there's been a good chunk of renovations done. For a burn property like that, there's a lot of structural that has to go into it. We have to get kind of engineer letters and go back to permitting, have approval. So it takes a bit of time. But I think, in a few months, it's going to be a nice looking place. And it's kind of cool. You briefly saw the front of the property before and then where we're at now. And so for us, it's a good feeling to kind of look and see that we're also like improving the neighborhood, but retaining some of the character of it. And we even do the ones that are kind of hard, like Bellows. So that's where we're at in Columbus. So we've got really two series within the same fund, our Series A, and I think it's helpful. You can look at the Series A to see what the Series B will kind of become. We've got, properties in Lexington that we'll also do a quick review of as well. Let's see if I'm sharing that. Yes. So this is a property we purchased, during the demo stage. And then once we get done with the property, we think we've kind of added some value to the community. So, these are kind of workforce housing type of build outs. There's nothing fancy. There's not, chandeliers or anything in there, but it certainly looks nicer than when we originally got it. So I'm proud of what we do. So the Series A, you can see our capital position as of September 30 was a little bit over 50% debt to equity. So we've got a pretty conservative capital structure, makes times where the interest rates go up easier for us. We might continue to refinance and reinvest in our Series A, but right now we're not a lot. Our Series B is currently open. So we've got 9 properties that we've completed, 4 that we're kind of in what we call final. And Bellows is almost in the final stage, once drywall is complete, all the finishing work. 8 that are in the initial and 4 that are in inventory. And we've really kind of picked up the pace. So you can see in the last 6 months, we've completed 5 properties. The Series B breakdown of assets, this is as of September 30 as well. We've gotten a financing package for the Bs, so there's a little bit more debt there. Not much. It's going to be 5%, debt. But we've started to deploy the cash into real estate. And here's one of the properties that's finished. So just the before picture right here. I'm sure it's a place that many of you would like to spend your Saturday afternoon in. And then you know, when it's complete. We are able to do, we kind of systemize, you know, scatter site construction and rehab is tough to manage, but we systemize some things. So for example, in Lexington, we'll have them just take a cheap $30 plastic template and they just take a blowtorch and blow over it, the, you know, horse's head, because folks in Lexington like that. And in general, the younger clientele, someone who might be a barista would think that's pretty cool. And then we'll try to retain this one unit, one piece of architecturally interesting structure. And so far that's worked pretty well. But the guy who runs Lexington is very systems oriented. There are, you know, 7 paint colors that they use, 5 primary, 2, you know, accent colors, and he keeps it running pretty well there. So running short on time right now. I'll just walk you through kind of our basic terms. But again, I recommend you to talk to us, get on our webinar, talk to us. Or if you're not sure if you want to invest in an OZ fund or not generally, we're happy to work with you. We create a kind of customized calculator for folks. They can walk through kind of your personal situation. What is your deadline? What would the benefit to being in an OZ be? It kind of measures the quantitative benefit, and then you kind of can figure out if it makes sense for you. Most of the drawbacks to being in an OZ fund are sort of qualitative, you know, having another K1, being tied up for 10 years. But a lot of folks kind of find that to be helpful. We're happy to do it gratis, whether or not Nest is the right choice for you. So we're a quirky fund. We want to find partners that are going to be happy with us for 10 years. But so this is our basic terms. We've got target leverage of 65%. We're way under that right now. Management fee of 1.5% net assets. Relatively low pref, you know, because the single families are not high yielding properties. But we offset that with a relatively low profit share. So far in the fund overall, we've got 11 million contributed capital. We've put in a little less than $1 million ourselves. We've gotten a grant from the city of Lexington for about $250,000. So we think we're doing good work. It's a battle. We're kind of always working on it. There's always fires to put out and things to improve, but we're pretty proud with what we've done. And I'll leave you with some of our contact information. I'll send to you afterwards the ability to hop onto our webinar and then download some resources on Nest Opportunity Fund. Jimmy, do I have any time for any of the questions?
That was awesome. No, but I'm going to give you one anyway. Clint, you did get one question, a little bit of pushback from Dan on an earlier chart that you had up showing the different risk spectrum of different property types within real estate, where you had single family and multifamily near the lower risk end of the spectrum. And then he was pushing back on how you had office rated as lower risk than industrial and self-storage. Would you like to address that?
I mean, yeah, I think today it's easy to say the office is probably one of the highest risk areas. But historically you really haven't considered that. But yeah, I think, listen, self-storage, where do you put that? I don't know. It's in miscellaneous is generally where people put it, but I think self-storage could be, you know, I think it could be kind of the most conservative thing, but also, you know, maybe people change how they store things or what they do with it. Maybe the pod systems will change that industry. But we know people probably will want to live, you know, in homes.
Good answer. Okay, well, Clint, we posted links to your website in the chat, and Anne just posted a link to your Zoom session that you are hosting next Thursday, March 21st at 1 p.m. Eastern time. So please do click on that Zoom link that Anne just posted in the chat if you'd like to join Clint's webinar next week.
2 Thursdays.
2 Thursdays from now. Yeah, that's
You're
right.
making me
Yeah,
nervous.
two weeks from today. Excuse me. I'm getting ahead of myself. That's 2 weeks from today. So you got plenty of time, but go ahead and register now for that so you don't forget. Clint, been a pleasure. Thank you so much for joining us today on another OZ Pitch Day. Really appreciate you.
Hey, thanks, Jimmy. It was fun.